Right now, at this very moment, every single country on planet Earth is drowning in debt. Not some countries, not most countries, every single one. The United States alone is buried under $38 trillion. Japan, $9 trillion. China, Germany, France, all of them. And when you add it all up, governments, corporations, every household, the total comes to $315 trillion. That's not just more than all the money that exists. It's 3 times larger than the entire global economy. Now, here's where it gets strange. If literally everyone on Earth owes money, then who's collecting? Who's on the other side of this equation? The answer is going to disturb you. Because when you actually follow the money, when you trace where these payments are really going, you'll discover something that sounds impossible. The world doesn't owe this money to anyone specific. It owes money to itself. But here's what they don't tell you. 4 men engineered it this way on purpose. The answer reveals something fundamental about how modern finance operates. When you trace the chain of creditors, when you examine who actually holds these debt instruments, you discover that the world doesn't owe money to any single entity. Instead, the global economy owes money to itself through an intricate web of financial obligations. But this wasn't accidental. 4 financial architects across 3 centuries deliberately designed this system. They created mechanisms where debt never gets repaid, where governments borrow perpetually, where interest payments flow continuously upward, and where the designers of this structure profit from every transaction, every crisis, and every bailout. This isn't speculation or conspiracy theory. These are documented economic mechanisms with verifiable historical records. The meetings occurred, the contracts exist in archives, and the financial structures operate as public record. Once you understand how these 4 individuals built the modern debt system, you'll recognize why $38 trillion in United States debt isn't a crisis requiring solutions. It's the system functioning exactly as engineered. Before 1694, monarchs borrowed money through straightforward arrangements. A king needing funds would approach wealthy merchants or nobles, promise repayment with interest, and receive gold or silver. If the monarch couldn't repay, he would default. Creditors lost their investment. The king would then seek different lenders willing to take the risk. This system carried inherent limitations from an economic perspective. It was extraordinarily risky for lenders because sovereign default meant complete loss. It was embarrassing for monarchs who damaged their reputations and future borrowing capacity. But crucially, the system was contained. Debt remained temporary, either repaid in full or defaulted entirely. When defaults occurred, the financial system cleared itself, the slate reset, and economic activity continued. This old system had natural boundaries. Lenders could only provide what they actually possessed in precious metals. Borrowing capacity was finite. Interest rates reflected genuine risk assessment. And most importantly, debt couldn't accumulate indefinitely because the mechanism for perpetual borrowing simply didn't exist. The economic architecture of sovereign finance was fundamentally different from what we know today. William Paterson changed everything about sovereign finance. A Scottish merchant and financial innovator, Paterson had attempted multiple business ventures throughout the 1680s and early 1690s with limited success. But in 1691, he developed an idea that would fundamentally reshape economic systems worldwide. England was engaged in expensive warfare with France during the 1690s. King William III desperately needed capital. The royal treasury had been depleted. Tax revenues couldn't cover military expenditures. Traditional lenders refused new loans because England had defaulted on previous obligations, damaging its creditworthiness. Paterson approached the king with a revolutionary financial proposal. He would organize a consortium of wealthy merchants to lend the government £1.2 million, equivalent to approximately $300 million in today's purchasing power. This was an enormous sum for that era, but Paterson's true innovation wasn't the amount, it was the structure. The loan would never be repaid. Instead of expecting return of principal, the government would pay interest perpetually at 8% annually. To manage this unprecedented arrangement, Paterson proposed creating an entirely new institution, the Bank of England. The economic mechanics were revolutionary. The merchant lenders would deposit their gold with the Bank of England. The bank would lend this gold to the government. The government would pay interest annually from tax revenues. The bank would distribute this interest to the merchant lenders. But the critical detail that changed everything: the government would never repay the principal. The loan was structurally permanent. Why would merchants accept this arrangement? Because the interest payment was guaranteed by Parliament and backed by the government's taxing authority. As long as England could extract taxes from its population, the interest would flow continuously. Additionally, the banknotes lenders received in exchange for their gold were tradable instruments. These notes functioned as currency, actually superior to currency because they generated interest income. Parliament approved Paterson's scheme in 1694. The Bank of England received its charter, merchants provided their gold, the government secured its war funding. And for the first time in economic history, national debt became permanent, not a problem requiring solution, but a structural feature of the financial system. The economic implications were profound. The government paid 8% interest annually on £1.2 million, totaling £96,000 per year forever. The merchants had essentially purchased a perpetual annuity from the government. As long as England existed and maintained taxing capacity, the income stream continued. If merchants wanted their capital returned, they could sell the banknotes to other investors. The debt was transferable but never repayable. Paterson's real genius emerged in what followed. The Bank of England received authorization to issue banknotes backed by the government's debt obligations. They could print paper money up to the value of the loan. This mechanism created money from debt itself. The government's promissory note became circulating currency. The more the government borrowed, the more money could be created. This established a template for modern sovereign finance. Government borrows and never repays principal. It pays interest perpetually. The debt itself becomes monetized as currency. From a banker's perspective, this is brilliant, a guaranteed income stream backed by taxing authority. From a taxpayer's perspective, it's economically devastating because you're perpetually servicing debt that never diminishes. Within 50 years, every major European power replicated this model. France created the Banque Générale. The Netherlands formalized government debt issuance through its sophisticated banking system. By 1790, the newly independent United States adopted identical structures. Alexander Hamilton explicitly modeled America's financial architecture on the Bank of England permanent debt, interest paid from taxation, bonds traded as monetary instruments. Paterson died in 1719 without accumulating significant personal wealth despite creating the Bank of England. But the economic system he engineered persists 331 years later. The Bank of England still operates. British government debt has never been eliminated. It's been refinanced, rolled over, and expanded continuously, but never paid off. The debt trap was set in 1694, and every government since has entered it willingly. By the early 1800s, European governments had embraced debt financing. They borrowed for military campaigns, infrastructure development, and operational expenses. But no organized market existed. Each loan required individual negotiation. Interest rates fluctuated wildly based on circumstances. Only the wealthiest merchants could participate in sovereign lending. Nathan Rothschild transformed this fragmented system into an industrial-scale operation. The Rothschild family began as money changers and commodity traders in Frankfurt. By 1800, the 5 Rothschild brothers had established banking operations in 5 major European financial centers: London, Paris, Frankfurt, Vienna, and Naples. This network was unprecedented in scale and coordination. They could transfer capital across borders faster than any competitor, and they leveraged this advantage to dominate sovereign debt markets. Nathan Rothschild, operating from London, was the strategic architect. During the Napoleonic Wars of the early 1800s, Nathan arranged loans for Britain, but his innovation was structural. Instead of lending directly to governments, he purchased government bonds at discounted prices and resold them to investors at markup prices. He created a secondary market for sovereign debt. The economic mechanism worked efficiently. Governments needed capital immediately. Rothschild provided it in full. Then he sold the bonds to pension funds, insurance companies, and wealthy individuals across Europe. The government received its funding quickly. Rothschild collected the price spread as profit. Investors acquired tradable assets generating interest income. But Rothschild's operation extended beyond simple intermediation. He positioned his banking network so governments had no practical alternative. His information network was superior to official government channels. His distribution network reached investors no other banker could access. His capital reserves exceeded competitors. This gave him effective monopoly power over sovereign debt issuance across Europe. The most famous demonstration occurred in 1815 at the Battle of Waterloo. Nathan Rothschild learned of Napoleon's defeat before anyone else in London. His private courier network was faster than official military communications. According to historical accounts, he used this information advantage to manipulate British bond markets. First, he sold British bonds aggressively, signaling to other traders that Britain was losing the battle. Prices collapsed as other investors panicked and sold. After prices crashed, Rothschild purchased massive quantities at drastically reduced prices. When official news of British victory arrived the following day, bond prices surged. Rothschild reportedly made millions through this market timing operation. Whether this specific account is entirely accurate remains debated by historians, but the economic principle it illustrates is documented. Rothschild controlled information flow, controlled debt issuance, and controlled market operations. By 1820, the Rothschild banking network dominated European sovereign debt markets. If a government needed to borrow, they negotiated through the Rothschilds, because the Rothschilds controlled investor access, managed distribution networks, and effectively set market terms. Here's why this matters for understanding the debt trap's evolution. Before Rothschild, governments could theoretically default on obligations. If a monarch refused payment, creditors absorbed losses and the financial system reset. But Rothschild made sovereign debt tradable across international borders and throughout complex ownership chains. A British bond might be owned by a French investor who sold it to a German bank who used it as collateral for a loan to an Austrian institution. The ownership web became so intricate that defaulting wasn't simply refusing one creditor. It meant collapsing an entire interconnected financial network spanning multiple countries. This is the Rothschild innovation from an economic standpoint. Make debt so interconnected across borders and institutions that default becomes impossible, not because governments are financially responsible, but because default would trigger systemic collapse across the entire European financial system. Governments became economically trapped. They had to maintain interest payments. They had to continuously borrow to service interest on existing debts. The debt trap was no longer merely permanent as Paterson designed it, it became inescapable through international interconnection. The Rothschild family accumulated extraordinary wealth during the mid-1800s, becoming arguably the richest family in the world. That wealth derived from a single source, interest income on sovereign debt. They didn't manufacture products or build infrastructure. They lent money to governments and collected interest perpetually. The system Paterson created in 1694, Rothschild industrialized and internationalized by 1815. Every government in Europe was economically caught. By 1900, the United States was emerging as an economic superpower, but it operated with a relatively primitive financial system compared to Europe. Banks functioned independently without coordination. Money supply remained tied to gold reserves. No central mechanism existed to manage sovereign debt at scale. John Pierpont Morgan addressed this limitation not for public benefit, but to protect his extensive banking empire and establish permanent mechanisms for debt management. In 1907, a severe financial panic struck. Stock prices collapsed, banks failed rapidly, and economic activity ceased. J.P. Morgan personally organized a bailout operation. He gathered major New York bankers in his private library, locked the doors, and compelled them to pledge their own capital to stabilize failing institutions. The intervention worked. The panic subsided, and Morgan effectively functioned as America's central banker. But he was 70 years old and recognized he couldn't personally manage future crises. Morgan and his banking associates, the most powerful financiers in America, designed a permanent institutional solution. They needed a central bank. However, Americans harbored deep distrust of centralized banking. The first and second banks of the United States had been shut down decades earlier due to populist opposition. So Morgan's group disguised their central bank proposal. In November 1910, Morgan's associates, including Senator Nelson Aldrich and representatives from America's largest banks, held a secret meeting at Jekyll Island, Georgia. For 9 days, they designed the structure of what would become the Federal Reserve System. The meetings were conducted in secrecy because they understood that if the public discovered that private bankers were designing the nation's monetary system, there would be significant political opposition. If you're enjoying this deep dive into economic history and want more content exploring how financial systems actually work, make sure to subscribe for upcoming videos. The plan demonstrated sophisticated political maneuvering. The Federal Reserve wouldn't be called a central bank, it would be termed a Federal Reserve System. It wouldn't be one institution but 12 regional banks. It wouldn't be controlled by Wall Street, it would be overseen by a board of governors appointed by the president. Superficially, it appeared decentralized, democratic, and public. But the structural details ensured banker control. The regional Federal Reserve banks were privately owned by member banks. Those member banks elected the boards of the regional Federal Reserve banks, and the regional banks influenced the Federal Reserve Board composition. The government appointed some members, but private banking interests controlled the operational system. Most importantly, the power to create money and purchase government bonds was concentrated in the Federal Reserve Bank of New York, which was controlled by the largest Wall Street institutions, Morgan's banking network. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't fully comprehend the economic implications of what they were authorizing. Immediately, the debt trap expanded dramatically. Now, the government didn't merely borrow from private banks with limited capital. It could borrow from the Federal Reserve, which could create money to purchase bonds. This created unlimited demand for government debt. Here's why this matters economically. Before the Federal Reserve, practical limits existed on government borrowing. Private banks only possessed finite capital to lend. But the Federal Reserve could create money by purchasing government bonds. The government issues a bond instrument. The Federal Reserve buys it with newly created money. The government spends the money into the economy. The debt obligation goes onto the Federal Reserve's balance sheet, backed by nothing except the promise that taxpayers will service it perpetually. This mechanism enables infinite debt accumulation. The Federal Reserve ensures there's always a buyer for government bonds, always demand, so the government never has to stop borrowing. It can roll over debt indefinitely because the Federal Reserve will always purchase it, and the interest payments flow from taxpayers to the banks that own shares in the Federal Reserve System. Morgan died in 1913, the same year the Federal Reserve was created. But his legacy is the institutional structure that makes the current $38 trillion in United States debt economically possible. Without the Federal Reserve acting as guaranteed buyer, the government couldn't borrow at this scale. Private markets wouldn't support it. But with the Federal Reserve as permanent purchaser, there's no practical limit. The debt trap became infinite in capacity. By the 1970s, the debt trap that Paterson, Rothschild, and Morgan constructed was functioning globally. Every developed nation borrowed continuously, rolled over debt obligations, and paid interest. But developing nations operated differently. They borrowed for infrastructure development, and many struggled to maintain payments. The debt trap was approaching its functional limits until Paul Volcker made it truly inescapable. Volcker served as Federal Reserve Chairman from 1979 to 1987. He confronted a severe economic problem. Inflation exceeded 10% annually. United States economic credibility was deteriorating. Foreign governments were losing confidence in the dollar. He needed to stop inflation, even if it meant triggering recession. In 1979, Volcker raised interest rates dramatically. The federal funds rate increased from 11% to 20%, the highest in American history. This policy crushed inflation through economic contraction, but it created another effect that would reshape global debt dynamics. Developing nations had borrowed billions of dollars during the 1970s when interest rates were low and credit was easily available. Now, those loans were maturing and interest rates had roughly tripled. Mexico owed $80 billion, Brazil owed $60 billion, Argentina owed $40 billion. They couldn't make payments. The interest alone exceeded their export revenues. In August 1982, Mexico announced it couldn't make scheduled payments. This was sovereign default. This event should have triggered global financial collapse. American banks had lent most of that capital. If Mexico defaulted completely, major institutions like Citibank, Bank of America, and Chase Manhattan would absorb massive losses. Some might fail entirely. The entire banking system faced systemic risk. Volcker could have allowed market forces to operate. Let the banks absorb losses from bad lending decisions. Let the market clear through defaults. But he didn't. Instead, he orchestrated a bailout through the International Monetary Fund. The IMF would lend Mexico, Brazil, Argentina, and other struggling nations enough money to continue making interest payments to American banks. These were called structural adjustment loans, and they came with strict economic conditions. The conditions were economically brutal. Governments had to cut public spending dramatically, privatize state-owned assets, open markets to foreign investment, devalue currencies to promote exports, and essentially dismantle their economic sovereignty in exchange for the funds to keep paying interest to foreign creditors. Here's the critical economic point. The IMF loans didn't reduce debt. They just rolled it over, restructured it to make it manageable, but made it permanent. This is the Volcker innovation in the debt trap's evolution. When debt becomes unpayable, don't forgive it through default. Restructure it through new lending. Provide just enough capital to keep interest payments flowing to creditors and extract political and economic concessions in exchange. The debt trap became a tool of economic control. Countries that couldn't pay were forced to open their economies, sell valuable state assets, and submit to foreign economic policy dictates in exchange for the privilege of remaining in debt rather than defaulting. This pattern has repeated continuously for 40 years. Greece in 2010, Argentina in 2001, and again in 2020, Sri Lanka in 2022. Every time, the same economic structure operates. IMF loans to maintain interest payments, austerity policies imposed, economic sovereignty surrendered, and the debt never eliminated, just restructured into perpetual obligations. Volcker died in 2019, but his legacy is the mechanism ensuring the debt trap operates globally and inescapably. Even when countries cannot pay through normal economic means, they're not permitted to default and reset. They're refinanced into permanent indebtedness. The interest continues flowing to creditors, the same banking institutions, the same financial system, the same structure Paterson created in 1694. Let me show you how these four architects built an integrated system where debt is infinite and escape is economically impossible. Start with Paterson's model from 1694. Government borrows but pays only interest forever, never repaying principal. Add Rothschild's innovation from the early 1800s. Make the debt tradable globally, so it's not one creditor, but an interconnected web spanning borders. Default would collapse the entire system. Add Morgan's mechanism from 1913. Central banks create money to purchase government bonds, providing unlimited demand. Government can always borrow more. Add Volcker's trap from the 1980s. When countries cannot pay, restructure rather than forgive. Keep the interest flowing. The result is what we observe today. $315 trillion in global debt encompassing government obligations, corporate debt, and household borrowing. None of it will ever be fully repaid. All of it generates interest payments, and all of it is interconnected through the global financial system so that default anywhere threatens collapse everywhere. Here's the specific economic mechanism using the United States as example. The United States government has issued $38 trillion in debt instruments. Who owns these obligations? Approximately $20 trillion is owned domestically. Pension funds, mutual funds, insurance companies, banks, and the Federal Reserve hold these treasury bonds. These institutions purchase treasury bonds because they're considered the safest assets available. But those bonds pay interest, currently totaling approximately $1 trillion annually. That interest comes from tax revenue, so taxpayers send money to the government through taxation. The government transfers it to bondholders as interest payments. The bondholders are predominantly institutions owned by or managing wealth for the already wealthy. It's a continuous transfer from workers to capital holders every year in perpetuity. The other $18 trillion is owed to the government itself through mechanisms like the Social Security Trust Fund and Medicare Trust Fund. The government borrowed from these programs and spent the capital. Now it owes itself. But ultimately taxpayers owe because when Social Security needs to redeem those bonds to pay benefits, the government must raise taxes or borrow more to make payments. It's an accounting shell game. But the interest flows regardless of the internal accounting. Now scale this globally. Japan owes $9 trillion, mostly to Japanese institutions and the Bank of Japan. Europe owes $14 trillion, mostly to European banks and the European Central Bank. China carries significant domestic debt held by state banks. Every country operates the same system, and they're all interconnected economically. Japan holds United States treasuries. The United States holds European bonds through IMF participation. Europe holds developing nation debt through World Bank operations. It's circular and self-referential. Everyone owes everyone through complex chains, and the interest flows upward to the institutions managing the debt instruments. Here's why this economic system can never end through debt repayment. If the United States paid off its $38 trillion in debt, the money supply would collapse. This is because dollars are created when the government borrows. If it repaid the debt, those dollars would disappear from circulation. This would cause deflation, depression, and economic collapse. So the government can never pay off the debt. It must keep borrowing, keep rolling it over, and keep paying interest. The same is true globally. If every government simultaneously paid off its debt, the global money supply would contract by approximately 2/3. There wouldn't be sufficient money in circulation to conduct international trade. The economic system would cease completely. Therefore, debt cannot be eliminated. It's structural and economically necessary by design. The system requires perpetual debt to function. Here's who profits from this structure: the institutions that hold debt instruments. Asset management firms like BlackRock, Vanguard, State Street, and Fidelity control tens of trillions in assets. They purchase government bonds using other people's money, pension funds, retirement accounts, insurance premiums, and they collect the interest. Approximately $1 trillion per year from United States debt alone, plus interest from Japanese debt, European debt, and bonds worldwide. That $1 trillion in annual interest payments flows from taxpayers to bondholders. It's the largest wealth transfer in economic history, continuous, structural, and invisible to most people because it's not called a tax, it's called debt service. But economically, it's the same mechanism. Workers pay through taxation, institutions collect through interest income, and the debt principle never decreases. The four architects didn't conspire together across centuries. They lived in different eras, but each solved an economic problem in a way that benefited financial institutions. And each solution built upon previous innovations. Paterson made debt permanent in 1694. Rothschild made it global and interconnected in 1815. Morgan made it infinite through central banking in 1913. Volcker made it inescapable through restructuring in 1982. Together, they constructed a system where governments borrow forever, pay interest eternally, and the people who control the bonds, who manage the debt instruments, who collect the interest, they're the ultimate economic beneficiaries. Not governments, not taxpayers, but financial institutions. And here's the final economic truth. $38 trillion isn't a crisis for these institutions. It's a business model generating reliable returns. Every dollar of debt is an asset on institutional balance sheets. It pays interest. It provides collateral for additional borrowing. And as long as confidence holds, as long as market participants believe the government will continue paying interest even if it never repays principal, the system functions indefinitely. The debt trap is complete. Economic escape isn't possible without collapsing the entire global financial system. Four architects across 3 centuries built one integrated system, and everyone on Earth is now economically operating within it. If this analysis changed how you understand government debt, if you now recognize that $38 trillion isn't an accident or policy mistake, but rather a system working exactly as designed, then you're beginning to see how economic power actually operates. The architects understood something fundamental. Debt isn't a problem requiring solution. It's the foundation of modern finance. And interest payments are the mechanism through which wealth continuously flows upward.